Welcome to the Millennial Money Canada podcast, a podcast to elevate your financial planning literacy so that you can live well, build wealth, give generously, and leave a legacy that you're proud of. I'm Guillaume Girard, financial planner, and I'm joined by my co-host, Sam Lightman, founder and financial planner at Millennial Wealth Advisors. The topic of today is tax planning for 2025 with the Canadian tax guy, Mohammed. So Mohammed is a partner at Copilot Tax, formerly known as Tax Heroes. He's used to work at a big four accounting firm. He eventually went to a smaller firm and then started his own tax services and advisory practice. The tax services include tax preparation, tax planning and consulting, cross-border taxes, and estate planning. The accounting and advisory services include bookkeeping, financial reporting, payroll, CFO services, fractional CFOs, and accounting systems and payroll setup. What sets them apart is the fact that they're very forward-looking and proactive into their tax planning approaches. And in this interview, you will hear him on various topics around tax, his positions, how he advises his clients. And you can, of course, find him on Twitter under the Canadian Tax Guy. So with that being said, let's dive into the episode. Mohammed, welcome to the Millennial Money Canada podcast.
Hi, how are you? Thanks for having me.
Can you share your story on where you started in the tax world and how that led you to Copilot?
Yeah, for sure. My career has really been in 3 stages. So the first stage was at a really big accounting firm. Second stage is at a lot smaller accounting firm. And then third stage is really my own firm. At the big accounting firm, just fresh out of school, I was working with this, one of the big 4 accounting firms. And if you don't know what they are, they're international. They work on like the biggest clients in the world. And so I was working really with the biggest companies in Canada and the richest families in Canada. And the work was very technical, a lot of US, a lot of ultra high net worth planning. But there was a couple of smaller clients, and it's from usually some older partners who had these relationships a little earlier that I was working with. And I found myself, working, helping them, spending a lot of time and helping them a lot. And not necessarily, getting all the credit, not billing all the time because the budget didn't allow for it. But out of pure interest, I would spend a lot of time with them because I realized the value to them was a lot more impactful than, billion-dollar companies or whatever the case is. And I think that led me to a point where I thought, I really have to continue specializing in these ultra high net worth families or companies and not a lot of these smaller companies. And I really enjoyed helping the smaller, your typical mom and pop business owner a lot more. So what happened is that led me to join a smaller firm. And the smaller firm, my friends, they purchased an accounting firm and they asked me to join. And so I came to this second stage, which is joining this smaller firm. And what happened is people started asking me typical questions that, your typical person or typical business owner would ask, like, salary versus dividends, how to reduce OAS clawback or TFSA or RSPs. And I actually had no idea how to answer any of these questions. It's sort of a hard realization when you spent like 6 years in tax and then someone asks you something like RSP versus TFSA, something that's applicable to almost all Canadians, and you're left blank. And so that really led me to kind of study a lot more, do a little more deep dive on typical business owner and individual taxes and financial planning. And what I found, after I kind of educated myself a lot more on those topics is people weren't really getting great advice, especially at that mid to high income tax level, right? They were getting, some advice. They had accountants, but the accountants weren't necessarily being proactive in providing them advice. And that is ultimately what led me to start my own firm. Is I wanted to be an accounting firm where we are very proactive. We're, meeting with clients on an annual basis, asking them about their goals, asking them about all these things, and providing tax planning proactively rather than reactively.
It's fantastic. So, I can imagine going into the business world would be a little bit different than being an employee, right? And I know you work with a lot of the people that are business owners now that probably made that transition at some point. What was the biggest, hurdle to jump through when you're like, okay, I'm used to a salary, or I'm used to, someone maybe setting my schedule a little bit for me, but now I've got to go and find all my own clients and I've got to start to really put my voice out there.
Yep. So that was definitely a hard lesson. And I thought, when I became self-employed, I'm like, I'm so smart. These clients are going to come to me. I don't have to do anything. And, a week goes by, 2 weeks go by, and it's like, all right, I really need some clients. Like, hopefully they can realize soon that I'm so great. And then at a point, I'm like, okay, so I really have to, I have to kind of bring I have to do the business development. Clients are not just going to come to me. And so that was a hard lesson on like, what do I do? How do I get clients? And I've spent a lot of time on Twitter. And so I started a Twitter account and I started tweeting things that, people might not think about, tax considerations that tend to be missed by your typical accountant, or you might not be thinking about at all, typical questions I get asked, when to incorporate, things like that. And that's really where I saw a lot of flow of my clients. Most of them actually come through Twitter. Some of them come from our website. But that's actually the majority of our clients. And so thankfully my tweets did very well. But other than that, what I realized a couple of months later is, I can't be fully reliant on Twitter or X, whatever it's called now, for getting clients. And I have to kind of look at other avenues. So I started, strengthening professional relationships, referrals, and worked on a lot of SEO. And so that was a good lesson for me in terms of how to run a business. And I think I was shy at it when I first started my business. And now it's what I love doing the most. I love marketing. I love content creation. If I could just kind of do that, and a lot of my job is that now, and my partner takes a lot of the fulfillment, but it would be probably like, it's the greatest thing. So I really love the tax. I really love the content creation, and putting those two things together is just, it's the best of both worlds for me.
I was laughing listening to you because we have a bit of a similar background where I was on the institutional side before. And then when I transitioned and you talked about just knowing the basics, right? It's like a whole new world that I had to learn with financial planning. But also like I came to this world with like CFA, CFP, CMTs, all certifications. And I thought, oh my God, maybe you think you're smarter than you are. And I was like, oh, people were just like, couldn't wait to open accounts with me. I was like, everyone's going to sign up. And it was crickets, man.
Yeah.
It took like a year to get started. But anyhow, it's very humbling. It's super humbling. But can you talk about why did you choose Twitter as a medium, and what kind of clientele gravitate towards you through Twitter or X as a platform?
Yeah, so I chose Twitter strictly because that's where I spent most of my time. Like I have a personal account, where I follow different people and stuff. And I'm like, you know what? I should just make a tax account. I wasn't familiar with any other kind of tax focused accounts. And so that's why I decided to use Twitter, because, there were big TikTok accounts or YouTube accounts, not so much on Twitter. And then, sorry, what was your second question? I missed it.
Who gravitated towards you? Who started reaching out to you? What was the type of clientele that were reading your tweets or interacting with you?
So Twitter, like the audience on Twitter is actually very educated, and they're quite knowledgeable. So I feel like maybe in other platforms, it's kind of a lower educated, and not to be offensive, but lower educated clientele. But when I started Twitter, it was very highly educated. They actually knew their stuff pretty well, but I guess they wanted kind of higher level advice. So it was actually pretty, well-informed people who kind of noticed, maybe they weren't getting the best advice or they needed appropriate advice. And they were the ones who reached out to me. And, our conversations specifically from the Twitter clients would be pretty technical, actually. So that was an interesting kind of dynamic. I thought I would have to talk about the basics, but people there are very well educated.
That's interesting. I found when I was starting at my TikTok channel, I found that a bit of a similar story, because I actually ended up having a meeting with the Canadian head office of TikTok a couple of years ago. I was in Toronto and they were like, hey, come out to this pizza place. We want to take you out for lunch and chat with you about your platform. And I was asking them okay, can you share some insider information here? Why is this doing well? How can I build a bit of a bigger platform? What they shared with me is they said, just focus on education, because the number one reason why people are on TikTok is entertainment, but the second biggest reason is education. And so I don't know if you noticed now, they've actually started a STEM feed, and basically just math and science and economics and education. And that to me is okay, they're recognizing what their platform is and people are there for education. The first few people that reached out to me for advice on TikTok, I was amazed. I thought, it would be people who were really struggling and didn't know what their first step was, but that wasn't the case at all. It was just people who'd flown under the radar at bigger financial institutions who were like, hey, I'm at this stage now and I need advice and I don't really know where to turn. So that was a really interesting realization there too. kind of a bit of a similar story on TikTok, although I think people maybe have this perception that, it's all, 18 to 22-year-olds on the platform and everything. But yeah, like it's really cool to see how social media can actually grow a business.
Yeah. I would have never like imagined this ever. And so when I tell people, some of my friends now, yeah, I get more from my clients through Twitter. They think I'm like joking around or they think I'm not serious. But we built a really big business just from Twitter and hopefully other platforms. And I think one other thing you said was surprising, these people tend to be well educated. And I feel like, the people who are actually getting missed on social media are the ones who are less educated on these topics, because it takes an interest to follow, your TikTok account or my Twitter account. And I think, we're if you make content on social media, you're actually going to in general attract higher educated clients because of that. They're taking interest in these things.
What's before diving into more technical topics here around the tax planning space, what's one of the biggest thing that you've learned about yourself or the business since you started Copilot?
Partnerships are hard, but they're amazing. So I have a partner and we have, different skill sets, and it took us 2 months to get our partnership agreement finalized. And there was times there where I thought, you know what, this is not going to work out. I'm just going to have to go on my own. And, he's very methodical and I'm very action oriented and impulsive. So I just want to get this partnership done. But he's like, no, we have to think about this and this and this. And that was a very tough struggle. But I think once we got that finalized, we really hit a great stride and things were flowing very well. And so I think it's tough, but it's actually great when it works well.
What's a piece of advice that you have for people who maybe are in the business community that are already partnered, but maybe don't have that formal partnership agreement set up or are thinking about partnering?
Yeah, I think it's super important. Just simple things like what happens if you pass away? What's the succession plan for the business, right? I think that's a topic that doesn't really get thought about a lot, right? Or, what happens if you can't make decisions? Or if someone becomes sick, what's going to happen and they can't work for a bit? What's going to happen to their income for that period of time? Like, who's going to take over the work? I think that these are very important topics that need to be discussed. And I'd probably say, at least start having those discussions, open up to it, because, so many things can go bad when you're running a business. And if you don't have any kind of succession plan or backup plan, that's only going to lead to more conflicts if it hasn't been pre-discussed.
Yeah, that's good advice.
Are you guys finding, what was your story actually on your partnership? I know I listened actually to a podcast and you mentioned a book, and I put that book on my to read. I think it's called Partnership Charter. Is that what it's called?
Yeah. Yeah, you got it. Our partnership's still evolving in how it looks. It started out with us wanting to work on every case together. And then it started out with us bringing each other into the mix when our individual expertise was needed. And then we kind of restructured things in October to focus more on Guillaume doing the technical and planning side and research side, and me leveraging my audience to build out a lot of that research into marketing material. And hence this podcast was born, which Guillaume does 99% of the work to prepare for, which I very much appreciate that, Guillaume. I'm sure that's going to change in the future. But it really comes down to, as well on the planning side, right? So who takes which clients? We're looking at differentiating the planning geographically as well as asset levels based, so that I can focus more on the directional vision of the firm, and Guillaume can work a lot more on the actual technical financial planning for clients. And so very similar to you and your partner, if I had the perfect job, it would be to manage my clients that I have worked with for a very long time, and then focus the rest of my time and attention on growing the business. Business development, marketing, social media, appearance on podcasts, media of all types. I really enjoy that part. And so, yeah, we're still evolving in that sense. Guillaume and I have been working together now for almost a year. So it's been good. But yeah, that's a bit of our journey into that. I think we've shared that with our listeners before as well. But yeah, I see so many parallels in how you're working through your partnership and how we're in the middle of working through ours and getting things set up. And I also see so many mistakes that others make, whether it's business owners that we're working with or other financial planners in our space, when, traditionally you hear, well, my word is as good as a signature. So just handshake agreements all around. And or I'm partnering with my best friend. And so, there's never going to be any issues or any disputes. And you don't really realize that like, hey, these partnership agreements, these formalizations of it aren't necessarily designed to, because bad things are going to happen. They're designed to help you when you're in a gridlock. They're designed to help you when you can't make decisions. They're designed to help you if the worst case scenario happens, one of you passes away or gets sick, or one of you decides it's not worth it anymore and wants to go start your own business. And I think people overlook that part. So I appreciated your advice because it's definitely in line with what we've been hearing and experiencing and seeing as well.
Yeah, no, it's good to hear. I'm glad we're not the only ones who, had these kind of rough times when working through our partnership. So it's good to hear. It's reassuring.
Yeah. I think one thing we've done well, we've got closer and closer as times go by. And then we had to repivot a few times as well. So we were like always nimble and repivoting and repositioning. And, who knows exactly how all 2025 is going to evolve. But again, we'll probably need to repivot as well as we grow and then new team members are joining the team, right? So we're very methodical. I feel like tactful into how we're growing, who we're bringing, and then how we're positioning the firm and how we're leveraging each skills so that everyone is focused on their highest leverage activities. That's Sam being the growth and the marketing side, and me being a bit more technical on the planning side. So anyhow, it's been great, but I think that's one thing. You always get closer over time. Don't start necessarily married and then having to go apart. It's easier to get closer.
Date first. You want to date first, and that's important.
I love that idea of being nimble because I think that's...
Sam, do you want to cover some of Mohammed's tweets, or I have a few questions if you want to dive into the next year's tax planning?
Yeah, so we definitely will cover next year's tax planning, Mohammed. But I'm a big fan of your social media and your Twitter feed. I often take little tidbits from it and talk to clients about it, and so I appreciate you sharing that. I want to talk about a few of the tweets that you've made here. One of them, which you posted a little while ago, which was you posted a screenshot of something you saw on a forum where the question was, can I deduct my Costco membership or Amazon membership if I use it to buy business items? Can you talk a little bit about how you view those types of questions and why you may think people are missing a little bit of the bigger picture here?
Yeah, so, this is not an uncommon question. This is something that's asked by a lot of clients. And, when I get asked, I'm like, I appreciate that they're thinking about tax, right? Because tax is a key part of your wealth. Reducing taxes is a key part of your wealth. But I almost have to kind of remind them that, you're talking about $150, whatever the Costco membership costs, $120, $160. And there are things like $60 for them, it could be like, 15 minutes of work, depending on what they're doing. And there are things that could save them thousands and thousands and thousands of dollars that they're probably not thinking about. They're not optimizing. Have they maximized their TFSAs? Have they maximized their RSPs? What is their structure look like? What are their investment? Not that I deal with investments, but are they thinking about investing, right? Like these sort of things, which have a way bigger impact than $60, and really move the needle. But you're thinking about like a $60 expense, and it's just about, reconfiguring how you think about your finances and, tackling the big items first before you're thinking about like little items like, oh, is this deductible? This $100? Is this, dinner deductible? It's really get the basics down, and then we can talk about, minor items.
There's a really popular tweet you made on December 11th that got 667 votes on a quiz. And the question was, a husband in Canada makes $30,000 in interest income and no other income. His spouse makes $0. If each of them makes $15,000 of interest income, would they pay more tax, the same amount of tax, less tax than if the husband only makes $30,000 in most provinces? I noticed you hadn't answered that question. Do you mind answering that question on our podcast here today?
Yeah, I'd love to. I love talking about income splitting, and income splitting is, shifting income from, higher income earners to lower income earners. And so if you can divide income amongst multiple people, usually that results in the least amount of taxes. But in this case, when you're married, or even if you're not married, the first $15,000 of income you make is typically tax-free. So some provinces have some differences, but typically it's tax-free. If you're married and your spouse also doesn't make any income, her $15,000 is also, first $15,000 of income is also tax-free. And if she doesn't use it, whatever portion she doesn't use, that can go on your return if you are, making more than 15,000. So let's say, she makes 5,000, you make 40,000. She has $10,000 of her exemption that's not being used. So that exemption can be transferred on your return, right? And so you're actually going to get the first $25,000 of income tax free. And lots of people aren't aware about this exemption, and sometimes they're so focused on splitting income between two spouses that they don't realize that if it's the first $30,000 of income and the spouse doesn't make any income, then you're actually not really saving any taxes at all. So it was just something I was trying to highlight, that the first 15,000 from the spouse can be transferred to the higher income.
So
Yes, exactly.
And so 27% of people got that right. 61% of people said that that situation would result in less tax, and 10% thought it would result in more tax. Fascinating results. That's an amazing question, because that's information that isn't really out there. Fascinating, highlighting the financial literacy aspect of this too, right? So that's fantastic.
Yeah, splitting income is great, but I think you just need to be mindful of who you're splitting income with and the amounts, right?
Can you elaborate a little bit on the income splitting strategies that you're usually recommending, and that may differ depending on the scenarios, but also given the limitations around on income splitting?
Yeah, I think when we think about income splitting, people think about, the most aggressive things, right? And before thinking about the most aggressive things, there are simple, I won't say simple, but more simpler things that can be targeted, right? Like many people who think about income splitting, they're not thinking about RESP, opening an RESP. They're not thinking about contributing to their spouse's TFSA, spousal RSP contributions, the basics before they think about paying dividends from the corporation, right? So I think number one, there are tons of ways to split income in more simpler ways and just as beneficial. Then when you want to get to the more advanced ways, I think this is a topic that, sometimes doesn't always get addressed when you're working with an accountant, paying dividends from your corporation to your family members. There are a bunch of restrictions. In 2017, the government set out a whole bunch of restrictions called the TOSI rules, where if you pay dividends to family members under certain conditions, it'll be taxed at the highest rate. But there's a lot of exemptions to those rules that don't get addressed very well, and brings about a discussion with clients. And there's sometimes some of them come with a bit of risk, but that sometimes people don't even bring up this, like the potential risk or potential opportunity. It's just kind of put to the back burner, and there's no discussion about it whatsoever.
We talk about risk tolerance all the time when it comes to investments, right? How much can you actually afford to lose, and how much risk do you want to put on the table to get higher returns over the long term? But we don't often talk about, we never talk about tax risk tolerance. Can you dive into a little bit more about tax risk tolerance and what that actually looks like?
Yeah, I think this is probably one of the least discussed things by anyone. And I think it's great that you guys talk about, investments, risk tolerance. I wish we did the same when we're talking about tax risk. And really, there's this idea of interpretation. So contrary to, what a lot of people might think, tax rules aren't objective. It isn't set in stone. Lots of things are left for interpretation. Different things can be interpreted in different ways, right? And so sometimes people can have conservative interpretations of things, and sometimes people can have kind of aggressive interpretations. And when we think about tax risk, there's really a spectrum, taking the least amount of risk, which allows for the least amount of tax planning. There's still tax planning available for people with low risk tolerance for tax, but it's just more limited. And then when you think about more aggressive tax risk tolerance, a lot more opportunities kind of open up. And so that's something that we don't discuss a lot. We've been trying to do a better job of discussing this with clients. Like, what is actually your tolerance? Like, if these are the consequences, if you're wrong, right? Are you okay with these consequences? Are you okay with maybe a little more CRA scrutiny from taking this position if it results in this much tax savings, right? And some clients are, a lot of clients don't have that risk tolerance. They just say, hey, no, we don't want to ever, even come close to CRA's radar, or we don't want to face any penalties whatsoever. But some people are like, I'm actually comfortable. I think that's a fair position. And I'm happy to debate this with the CRA because not ultimately the CRA that decides. Like if you disagree with the CRA, it can go to tax court. Like if a CRA doesn't agree with me, I'm pretty sure the tax courts will agree with me. And if you have that discussion, then a lot more opportunities kind of open up, especially with income splitting.
Can you give some examples here?
Yeah, perfect example. Okay, so let's say we have a doctor, right? And he has a corporation. He does his medicine professional services through his corporation. And his wife also works in the corporation, right? She does the billings, she does the bookkeeping, she does payroll, right? She works, let's say, 10 to 15 hours a week on all of that. He's, working full time or more than 40 hours a week, but she's doing 10 to 15 hours. Now, a lot of people will take the position that she's working, the TOSI rules say she can't, if she receives dividends and she works less than 20 hours a week, then they will be taxed at the highest tax rate. But if she works an average of more than 20 hours a week, then, it'll be taxed like a regular dividend. But if you actually look at that rule, what the rule says is TOSI won't apply, and TOSI are the punitive, income splitting rules. TOSI won't apply if she works an average of 20 hours a week, or, and this is where the interpretation comes in, she's actively engaged on a regular, continuous, and substantial basis. People often ignore that, right? There's a lot of interpretation of that. And some people just say, you know what, it's too ambiguous. We don't want to take the risk. We're just going to focus on the 20 hours. A lot of more people can apply for that, potentially qualify for that exemption, right? So is she working on actively engaged on a regular and continuous and substantial basis? Now, some people who have no risk tolerance will say, you know what, it's too ambiguous. I'm not even going to think about it. If I don't qualify for the 20 hours, then so be it. I don't qualify for this exemption. Someone with a little more risk tolerance will be like, yeah, you know what? She is actively engaged. She is working on a regular and continuous basis. Maybe it's not substantial, right? And as someone with a little more risk tolerance, I don't think this is high risk, actually. I think this is kind of like a medium to high risk. We'll say, you know what? It is on a regular, substantial, and continuous basis. And so TOSI rules should not apply. And so we should actually be able to pay her dividends without TOSI applying. And if you never have that discussion, which I don't think gets had a lot, you would never pay her dividends, even though maybe the client's okay with that level of risk, right? So I think having that discussion really opens up a lot of the tax planning opportunities, especially with TOSI.
That's fascinating. I remember when, going back a little bit, I remember when my wife and I got married in 2015 or 2015. Hope she doesn't watch this podcast. To second guess that. But when we got married, that was the last year where we could do spousal income splitting. And she was a student and I was working full time. And so we got to actually split our employment income together as a married couple. And then government came in and said, no, you can't do that unless you're 65 or older. So senior income splitting came into the picture. And then they tightened up the rules around paying out family members from corporations if they're not actively involved in the corporations, kind of what you're referencing there. And yeah, I find that a lot of the clients I talk to, number one, a lot of this stuff just goes over their head, which is why there's a need to engage professionals like yourself in tax planning. But also, even when they engage professionals, a lot of it is, hey, look back at our last year. How can we save the most amount of tax on the things we've done? What are all the deductions we can claim? And then come see us again and we'll review your last year's tax situation again, versus planning for the next year, the next 2 years, or the next 5 years in advance, which can bring about different structures, different planning opportunities and things like that. So I think it's a really good point to highlight there, what you did with the risk tolerance side of things too. And I imagine there's so many other examples of different types of tax risk that people can decide to take on or leave. I also imagine that in a regular situation, you've got business owner, family, those types of things. There's probably not a lot of risk tolerance in those families. But when there's, let's say, like big transactions happening in 1 year, like a $3 million sale of property or something like that happening inside of a corporation in 1 year. And you're like, okay, well, this is going to be a big capital gains tax and all this stuff. Like people are probably get a little bit more aggressive on those measures. Am I accurate in assuming that? Or
I think
what do you see? Yeah.
When we're dealing with sale of a business, I think that's the point where I see them people, are willing to be the most aggressive. Things that they wouldn't do ever, risk that they wouldn't ever come close to. All of a sudden, when they're selling their business, they're like, no, this is something I'm willing to tolerate. This is something I'm happy to defend, because the amounts are a lot more material. The benefits a lot more material. And so they're kind of fine taking that risk at that point.
Ideally, there'd be proactive planning done in the structure in order to minimize everything, at least. Yeah, ideally, that would probably be the best scenario. But in some cases, some people might end up in a situation where, like you said, they need to be on the aggressive side to minimize that tax bill, right?
Exactly,
Uh,
yeah. And there
yeah,
are things that are left for interpretation, and whenever you have things left for interpretation, that's always going to bring a wide spectrum of interpretation. So I don't think it's a bad thing to be aggressive, but I think it's just making sure you understand the consequences.
going back to the discussion around paying yourself, can you elaborate or discuss what is your approach to advising a business owner on how they're paying themselves, whether it's salary through dividend?
Yeah, we kind of have, 5 broad steps we take. And then when we break it down, it ends up becoming like close to 30 steps. But if you think about the 5 broad steps, number one is, what are you investing in? So some people are very real estate focused, or they're reinvesting in their business, or they're investing in other private businesses. And then others are more security oriented, right? And personally, I like to be a little bit more security oriented just as a diversification factor. But some people, they just take all that risk and they invest in, all these different things. And I think that's the first thing to understand. What are you investing in? And then the second thing is, how much income do you need, right? If you can rely on your spouse's income, who might have a job, that's ideal because you can pull out a lot less money from your corporation, have it taxed relatively low. But so then the second thing is really, how much money do you need? And then the third thing is, pay out this money even if you don't need it. So even though it's kind of ideal to leave things in your corporation, pay yourself as little as possible, in some cases, you actually want to pay yourself money even if you don't need it, depending on the different kind of facts that you have in your situation. Lastly, it's pay out money if you do need it, right? If you've kind of paid out all the money, you've gone through all the steps to pay out money that you don't need, then you look at, and you still need money, then you look at money that you do need, and how do you pay yourself? How do you pay yourself that money that you do need?
Are there general best practices that you find for companies that are, let's say, earning over the small business deduction limits and can afford to pay themselves full salary to max out RSP contribution room, but they kind of have to decide, hey, I want to pay salary or dividend? I know it's a very generalized question, but do you find that normally, even though we have integration and it's supposed to be pretty equal, do you find normally one type of person is better off doing dividends and one type's better off doing salary, or generally people are better off doing one or the other?
Yeah, so I think if you're investing, if you're earning a lot of investment income, usually dividends it lends to paying dividends, versus if you're kind of just starting off, generally it lends to kind of paying salary. And then where you're earning some investment income but not substantial, then you kind of have that mix typically. I think it also depends on how much you're making. I've seen people pay dividends when they're making, like you mentioned, above the small business deduction, because they have a certain attribute, which is grip. And when they're paying that dividend, it just kind of causes a circular kind of formula where you're paying grip, but then you're getting grip, and then you're paying that grip, and then you're getting grip, whereas paying salary sometimes might actually be better.
And you mentioned the investment income as the portfolio grows because they're generating RDTOH balances. So then you're using those to pay out dividends more efficiently. Is that correct?
Exactly. Yeah. So your RDTOH, and there's, I guess, 2 subcategories. Your and I hate using these categories because I think it's so wordy and it's just so confusing. But ERDTOH and MERDTOH, those are temporary taxes. And when you have those temporary taxes, paying a dividend can get you those temporary taxes back. And so you might be better off, especially when you have those balances, to actually pay a dividend rather than paying salary.
So one of the things that you said there, which caught my attention, was, when you have larger balances, it could be better to pay dividends because of what you just mentioned. But, you typically don't see that with business owners until they're getting, their business is well established, they've built the foundation out, and then they're investing a significant portion of their profits. And so what that generally leads to is, okay, maybe for the first 15 years of owning the business, I've paid myself a salary, I've deducted my business income by paying myself a salary, I've contributed to my RSPs, but now I'm earning substantial profit. So over and above my RSPs, I'm putting money in my corporation. What I would tend to see there is that the older a business owner gets, the 45, 55-year-olds, probably is a pretty optimal time to really start considering hey, I've been doing this for 15, 20 years. Maybe now it's a good time to look at switching because I'm accumulating, like I have a lot of money in taxable RRSPs for when I withdraw. I have money in my corporation. I can probably be a little bit more tax efficient in terms of paying myself as well because I've got a significant net worth. I may not need CPP as a supplement anymore. So paying into CPP may not make sense after a certain period of time. Those types of conversations. Are those all things that you typically would have with clients or you see very common practice? Like the larger balances are typically with a little bit older clients and they've already contributed quite a bit to their RSPs at that point in time.
Yeah, exactly. So that's exactly what the situation is. Well, usually when you start off, it's the salary. And then once you've built up that portfolio where it's generating quite a bit of investment income each year, then that's kind of the transition to dividends. And exactly like as you said, I'm actually going through that right now, where I'm trying to get a client who's in this exact same situation to, stop paying the salary and move to dividends because he has RD2H balances and, other balances that are beneficial. He's actually, and this is rare, he's such a strong believer in CPP and RSP that he doesn't want to let go of the salary, even though I've walked him through the numbers and I said, dividends are actually better for you going forward. But yeah, that's exactly what you said, right? Once you get a bit older, then it kind of lends to kind of paying more dividends than paying more salary.
I feel it tends to be the opposite. I feel I have a sense that people usually despise CPP quite a bit, or at least things that they would do better on their own and whatnot. So if you have to characterize the people that are coming to you for tax advice on this situation, where do you usually find their beliefs are if you have to generalize?
Exactly what you said. People don't like paying CPP, and almost everyone, and we have a whole calculator. It's available on our website, kind of show you salary versus dividends when you just kind of incorporate. And whenever people see an extra 6K of money being not, going towards CPP, it's hard for them to kind of accept that paying salary is better, right? It really is. But that kind of helps when you talk about the RSP room, and it kind of helps when you talk about the other benefits of CPP besides just income for retirement, right? There's basically it's a form of life insurance in a sense, it's a form of disability insurance. It's guaranteed income that can be split in retirement. And even though income probably would already be split with retirement if they have it in the corporation, but sometimes I try to explain these things to kind of make it better in terms of paying CPP. But yeah, that's usually the challenge. The challenge is always the CPP with new clients.
I don't think that's unique to clients. I think a lot of accountants have pretty strong beliefs on CPP as well. I've had my fair share of conversations with accountants, and I try to not get argumentative when we talk about these things because obviously we want to make sure we have good relationships with our clients' professional advisors. But I've heard numerous times where accountants are saying, well, especially with the additional CPP, now that's being owed, it just doesn't make sense to pay salary anymore. And I think they have this kind of mindset that it's a payroll tax, which has been very well characterized over the last 15, 20 years or so. And I think that when I look at those situations, often these are people taking extremely high risk in their everyday with the way they are building their business, right? You're betting on yourself, you're investing a lot of capital into one thing, betting that it's going to be profitable over the long term and those types of things. And then also inside of your business, you may be, because you're a high risk taker, you may be prone to more high risk investments and those types of things as well. Having a base, even though it's not substantial, that could be that base underlying retirement income of CPP does create kind of that annuity style of income coming into a retiree's life and kind of saying hey, listen, regardless of what this is, you can de-risk a little bit by paying into CPP as well. And not everything has to be high risk, high reward in your life. You can diversify your risk a little bit over here by using this as a platform as well.
Yeah. In all honesty, I used to be one of those people. I used to be very much anti-CPP. And I think a part of it is, accountants were really, we're very well-trained in tax. We're not always well-trained in investments. So it's hard for us to think about risk in investments. And we might just be purely focused on return. And so when we see something like a 2 or a 3% real rate of return, it's hard for us to think, oh, that's good, because we don't realize that the guarantee factor of it is substantial, right? Having a guaranteed return is hard to understand for us because we don't really understand investment risk. And so when I started reading a little bit more about investments, I think that's the time where I really appreciated, like, oh no, this is risk-free, and risk-free is actually very important. When you think about the risk-free return, that's inflation adjusted, that's actually very beneficial.
A lot of our audience is, and a lot of my connections on LinkedIn, and I'm sure a lot of your connections on X are other financial professionals, financial advisors, financial planners. We rely very heavily on, like speaking for myself, we rely very heavily on tax professionals in our clients' everyday life to work on the more complex side of tax planning. What are some things that you've seen that from the financial planning world, if I'm kind of putting you on the spot here, but that are common mistakes that financial advisors make when talking to their clients about tax and not getting a CPA involved, not getting tax planners involved? What are some of those common things that you see financial planners doing out of wanting to be more holistic and be more well-versed on the tax side? Is there something that comes to mind there?
So, maybe I'm biased because I see my community is really a strong group of financial planners who are really well educated in tax. And so it's hard for me to see the mistakes. And, there's a great community, the FPAC community, which is, very tax intensive. I don't see too many mistakes from, that community, but maybe other kind of investment advisors I work for, taking really aggressive positions that don't necessarily make sense. Like, just pretend like it's almost like just pretend that the wife works for the business and just pay her a dividend without, considering what the tax risk is for that. So, very aggressive positions or advice without understanding the intricacies. These are, common things I see with all types of tax advice. There's a lot of intricate rules that come into play with anything. And oftentimes, we don't do a good job of, we as an accountants don't do a good job of kind of highlighting how intricate tax rules are and like all the different, things that could come into play. And so when we see other people kind of giving advice, tax advice, directly without, maybe saying confirm with an accountant or telling them to confirm with accountant, I think that is kind of something that I've seen before and kind of leads to issues when we have to kind of knock it down and tell them, hey, there's actually this and this and this.
Makes a lot of sense.
Yeah. That's why we launched a financial literacy podcast, and to help advisors and clients elevate their knowledge around tax and investing and all these important topics. What, aside from the financial planning world, like what are some of the mistakes that you're seeing business owners or employees making around tax planning as we roll into 2025?
Tax planning. Yes. Let's see. So I think one of the things actually you guys mentioned to me, which there's tons of issues, is just on shareholder loans. Lots of people take out money from the shareholder loans, and generally they actually know, that it's not something they should do, but, they're doing it with a little twist, right? So some people say, you know what, we're paying it back after 2 years. And this is where I met, one of the intricate tax rules. Sometimes even if you pay it back within 2 years, there's other issues. So it's not that you have to pay it back within 2 years. It's within the second year end after you take it out. So if you, let's say your year end is December 31st, you take it out December 1st, that after that 1 month, that's your first year end. In the following year, so December 31st, 2025, that's when you have to pay it back by. But some people think 2 years and they think, 730 days or whatever the case is, but it's actually 2 year ends.
Can you just clarify to our audience what a shareholder loan is?
Yes. Good point. So shareholder loan is when you borrow money from your corporation. So generally when you take out money from your corporation, you have to take it as a salary or as a dividend, but some people lend it with the kind of idea that they'll pay it back eventually. There are tax issues when you do that. Generally, you have to include the income, the amount of the loan in income. And so when that happens, it doesn't look so pleasant. Now, there are current key exceptions. One exception is it has to be paid back within the second year end. Some people interpret this as 2 years, but it's actually the second year end. The other thing to keep in mind of when you do that is there's also an imputed interest benefit, which means, you have to pay tax on interest that, you would have received on that loan. And that tends to get missed quite often. A lot of people don't actually do that one, to be honest. A lot of people think if you're charging interest, then it's fine. You can take out a loan for as long as possible. Again, that's not that doesn't work. If you lend it to a family member or a close friend, then it's not a shareholder loan anymore because they might not be a shareholder. Again, that also doesn't work. And then a very common one I actually see is people think they can borrow from their corporation and take out a shareholder loan to buy a home. And they do this because there's this one rule that says one of the exceptions for, an employee loan is if you use it for a home purchase. But the requirements on that are key. And it has to be because you're an employee. So, if you're an employee for a similar company, they would give you a similar loan. And so generally, most business owners would actually not be able to do that.
And don't you have to also offer it to a group of employees as well? If you have other employees in your business, you can't just make it available for one employee.
So there's a little bit of a debate on that. They said it has to be because you're an employee versus when you're a shareholder. And some people could argue, I'd only do it for top level employees. And maybe that works, but it has to be that similar company as yours would offer that to you as well, right? Like would offer to all their employees at that level. And if no other companies are kind of doing that, then it'd be hard to argue that, if you're not offering it to other employees, that this is because of your employee relationship rather than your shareholder relationship.
Fascinating.
Have you changed your stance on how you advise clients since the change in the inclusion rate from 50% to 2/3 for incorporated professionals?
We're talking about capital gains inclusion rates here on capital gains taxes.
Yeah. So I think, first of all, in terms of general strategy we have, because number one, I think one thing you guys do a great job of, you as financial planners and investment advisors, is take a long-term view of someone's, plan or someone's career or life. And sometimes we accountants are very short-sighted. So, I think this is important in terms of long-term planning and kind of help focus, what could change of tax rates mean in the future and how should we adjust our tax planning for that. Another thing it helped in a general standpoint, not in a specific standpoint, is that the idea of optionality. So lately, especially in the past couple of years, tax rules have been proposed, but not, they haven't been passed, or they've been up in the air. There's a lot of uncertainty around the tax rules. And so doing tax planning that allows for more optionalities, that lets you, make decisions later, is really good, because we never know what happens with the tax rules. Will the capital gains tax increases pass, or will they not pass, right? So those are two general kind of ways we've changed our planning. But in terms of if we think corporations are not a good idea anymore, we still think it's a great idea. It hasn't changed necessarily our planning. We think the benefit of the tax deferral is huge, and that could result in massive amounts of increased wealth. Tax deferral can actually increase how much money you have, when it's all said and done. And so that the benefit of the tax deferral generally outweighs the increase in the capital gains tax for corporations. And
so it's so obviously, the end tax rate is still going to be more for an incorporated individual who has a large capital gain that they've been deferring. I know some of the speculation out there was, hey, you should cash in this large gain before June 25th of 2024 to realize tax at a lower rate, reinvest, and then have a new adjusted cost base or a new investment value that will then be the floor of your investment portfolio going forward. But we were talking to accountants and doing some modeling, and I think PWL had a great tool about this as well, in terms of should you defer, should you realize the capital gains. And I think the sweet spot was right around that 4-year mark. Like if you need the money before 4 years, then maybe it might be a good idea to cash it in before June 2024. Obviously, this is past now. But anything beyond that, the power of the deferral on continuously not having to pay tax year over year over year on that deferred capital gain on your portfolio or property or whatever you have is still much more powerful to hold on to. Also, we talk about this all the time. Another type of tax risk is policy risk, right? Like, will tax policy actually change again in 10 years, 15 years? It does seem to be something that governments enjoy playing with. And so the first thing, the proposed capital gains taxes, while they apply, haven't really been passed into law yet, which, depending on the political situation, may not be if there's an election before March, if I understand that correctly too, right? So there's so much stuff that's up in the air with this. And My experience has been, and correct me if I'm wrong here, but making snap decisions based on policy changes, unless it's really, really substantial, like I was doing surplus stripping before and now I can't, or something like that. But making snap decisions or knee-jerk reactions to policy decisions generally isn't a good idea unless there's something glaringly obvious in your face that is obviously the right decision to do.
Yes, that's something I stand by 100%. And that's, something I've come to learn. This is probably one of the worst things in my, throughout my career that I saw is people would do tax planning based on expected budget proposals. Capital gains increases, they've been said they were expected to increase in like maybe the past 7 budgets. And every single time, when I was at kind of the big accounting firms and, they do great work, but I noticed that about them is they'd be like, the budget, we think capital gains are going to increase. Let's do some planning. Let's do some planning. And I was actually working with a client who had done planning, the past 2 years in anticipation of this capital gains increase, and it never happened. And now it happened, 5 years later from when they actually did the planning. And so I think making very snap decisions based on policy is not the best idea. And it's even worse if you do it on proposed policy decisions that haven't even, been passed yet.
Yeah. Okay. I want to talk about one more thing here. I know we're coming to time, but okay. So there's this multi-generational housing tax credit that was proposed in 2023 that allows Canadians to build an additional unit onto their home and to house their elderly parents or a disabled family member under the age of 65 and over the age of 18. Okay. So there's a tax credit that got passed that allows people to claim up to $50,000 in the cost of renovations. And they would net about $7,500 into their pocket back if they do this. But one of the things in the Globe and Mail wrote an article about this, there's no expectation of rental income coming in from that secondary unit, and you're building it attached to your primary residence. CRA clarified at a roundtable in October that that secondary unit would not be eligible for the principal residence exemption going forward. I don't know if you have any more detail to get into on that or thoughts on that, but I found that to be a bit of a sneaky trick, because if we just had our parents or grandparents come live with us and we're taking care of them, taking costs away from potentially medical, the government in terms of compensating for the medical side of things, those types of things, or increasing density, making housing more available, all of that stuff, that would be a benefit. But why do you think they've introduced this, or do I have this wrong?
No, I actually never heard of it before you mentioned it to me. And I was almost shocked. I had to read the article and, look at CRA's interpretation. And I do think sometimes CRA gets a bad rep for certain things. They aren't the ones making the rules. They have to kind of interpret the rules. And these, the multi-generational tax credit and the principal residence, those are 2 separate rules. And I don't think there was any thought about how they interact. So they're, based on what the rules say, CRA is saying, you can only claim your principal residence exemption on 1 unit, and now you have 2 units, so it's possible you might not be able. And I get what they're coming from, right? They are just interpreting; they're not making the rules. But in the past, they've also been lenient on certain things, especially if you're building a basement and you're renting it, and it's not like you're making any renovations. They're willing to kind of say that that's 1 unit. So I think they could have been a little more lenient. Because obviously the intention here was, I don't think the intention was actually to not have the principal residence apply. And so I was a little surprised with that. And I don't want to blame the CRA, but I think they could have been a little bit more lenient on this.
Makes sense.
In the investment world or in the financial planning world, we focus a lot on behavioral coaching, around guiding clients, trying to get them away from making emotional decisions or maybe short-term decisions that might hurt them in the long term. You touched a little bit on it a few minutes ago, but can you talk about how you approach coaching clients through different situations and avoiding them to maybe again try to anticipate a change in tax policies and whatnot? And what's your approach there as to helping clients make the best decisions today, but also for the future?
I think this is something we're really working on, and we're kind of, we're still working through. And I would love to hear actually your approach, because this is something, we hear, and it's hard for us to kind of overcome that because people have very strong beliefs over certain things. Like CPP is not going to be around when I'm 60 or whatever the case is. And Actually curious how you guys manage that.
Well, there's a lot of different ways you can manage it, but I think sometimes you have to tolerate it to the point where it's not financially damaging. But then when it comes to the point where it could be financially damaging, like I want to sell in a down market, you can take two approaches, right? You can rationalize it with them, right? And you can say, okay, well, if this is actually going to go another 20% further, when do you want to get back in? And if we look at the last 4 or 5 drops and they've recovered in X amount of time, right? You can kind of rationalize with them. In some cases, you want to hear them and you want to just listen and say, yeah, I understand. I understand where you're coming from. I understand how you're feeling and empathize a little bit about that. And then remind them, listen, you're paying me to do my job. You're paying me to be your advisor and your coach. Here is my advice, black and white. Yeah, I've heard you. I understand where you're coming from. Here's what we need to do in this situation. And so often it comes down to people just wanting their feelings to be a little bit more validated than just an internet forum, talking to a professional and wanting that advice, and then having the implications of their decisions laid out. Because when we're thinking emotionally, which money is such an emotional topic, when we're thinking emotionally, it's really hard to make rational decisions. I don't know if you ever read the book. It's by Daniel Pink, and now the name's escaping me, but he gives the analogy of the elephant and the rider, and how the elephant is the emotional side of your brain and the rider is the rational side of your brain. And like, if you're very much in control, you can guide the elephant to where you want it to go. But if you're out of control, that elephant's going to go wherever the heck it's going to go because it's a huge beast, right? And that's kind of the emotional side of your brain. And so if we can help be that rational sounding board for clients in moments of high emotional stress, then often we can help them avoid bad mistakes and remind them that I think from the beginning too of our relationship, we let clients know, hey, listen, you're paying us for advice. So we have to know that if you're going to work with us, you're going to take our advice. And if you're not going to take our advice, then this probably isn't the right fit, right? And that doesn't mean just when times are going well. That also means when things aren't going well. Things happen in your life. Things happen in the markets. We see tax policy change and you want to make a knee-jerk reaction or decision. And walking them through that, being proactive, calling the people you know might be a little bit more emotionally reactive to certain situations. And even like a great example, had a situation where someone called me and said, hey, Sam, why is my money down so much over the last 2 weeks? And I'm like, okay, well, let's look into this because the market hasn't really dropped. So I was like, okay, I'm just driving right now. I'll look at it when I get home. No problem. And he was very, a little bit panicked about it. And I was just calm and just, okay, yeah, no problem. I'll look into it. Sure enough, I looked into it and it's like, well, you were looking at an individual account, not your total accounts, right? And so all of a sudden it's like, okay, yeah, okay, that makes sense. So I'm actually not down. No, you're fine. Don't worry about it. Those types of situations where clients get emotional, you've got to be able to be able to talk them through it, hear them, validate what they're going through, but then come back with a very rational response and not get caught up in the emotion with them. And I think that's our job.
I'm going to have to listen back to this and take some notes because you actually said a couple of good things that I think we need to implement. Definitely part of our client onboarding process. Question.
I'm still figuring it out. Like, it's only been 2 years since I've been dealing with retail, individuals. Before it was most institutions, like I said. And I'm still fascinated by trying to understand how people think. And even though you walk them through different scenarios, whether they had a big loss and walking them through, well, if you had a new pool of money, would you put your money back into those losing stocks or would you put it in a different portfolio? Like, even if you try to help them rationalize certain decisions, sometimes it's really challenging to get people to follow through with their recommended actions. And this is something that I think I'm still personally working on every single day, as to better communicate, better understand, better meeting them where they're at, and better understanding what's in the way of them carrying through, right? Because you can show them conquest planning. We have 150 different charts on what you should not do with your money. And, we've built a whole Canvas suite. We have all the resources, but that's not the answer. This is part of it. And there's like the understanding kind of, where they had and help and coaching them through that motion, which I think is a skill in itself that I think
you have
better
to know
every day, or we're getting better every day.
Right. And you have to know your client. And this is, I think, a bit of a competitive advantage that people who decide to stick with small client groups have, is that they know the person calling in much more intimately than if they were working with someone else that was also working with 1,000 other clients who maybe chats with them once every 3 years. Right. And the level of trust, the level of communication, and the level of knowledge we have about each individual client is very, very high. And so we can honestly predict a lot of when our clients are going to call us and why, if things happen or change. Obviously, if unique circumstances in clients' life, we can't predict those. But when things are in the markets or tax changes or things like that, we're usually pretty proactive in those things. And this is the benefit of, working with people who actually take time to learn your situation, to learn about who you are, your family, your reactions to money, your history, all of those things. Like we have a goals and values meetings for our clients. It literally walks through like, tell me your history. What did you do in 2020 when COVID drop happened and market dropped 20%? What was or 30% in a month? What was your reaction? If you were investing through 2008, what did you do? What did your advisor tell you to do? How are you feeling? Those types we ask those questions in our intro meetings so that we get a good full understanding of our clients. And that's, I think, when the relationship starts out like that and the trust is being built up piece by piece by piece, then when those times happen, it becomes, hey, I trust you. What should I do? Instead of this is what I want to do this for me now. Right. And that's a much different dynamic.
I like that. So you're kind of assessing their, their ability to their emotional capacity and their, their emotional maturity to deal with, bad situations, whatever the case is, prior to accepting. And then you're kind of educating them.
Yeah. Yeah. Big focus on education, which I feel like could play so well into the tax side of things too. Like, hey, what did you do when, income splitting got canceled? Did you try to aggressively game the system or like, those types of things? Like, I feel like that could probably have a lot of parallels into the tax planning world as well.
Definitely. Yeah. I'm definitely going to listen to this again and take some notes, actually, and reconfigure how we kind of do our onboarding. Cause I think you've mentioned a couple of good facts here that I want to kind of take away.
Right. Mohammed, thank you so much for coming on the podcast. And just as a reminder, listeners can find you on Kenyan Tax Guy on the platform X. And I will also link your website if they want to get in touch as well and inquire about your services. We have the Facebook group, Financial Independence for Business Owners. And the first meeting is going to be in January 22nd. So if you want to circle that, it's going to be around the book Profit First, I believe. And as usual, you can find us on mwadvisors.ca and you can find all our social media links down below. Thank you for listening and see you in the next episode.